Right, you should be able to see the slide up there. I'm going to talk through SA and global equities, give you our key views. We put out a quarterly strategy document at the beginning of every quarter, and we call that the Navigator. That went out a day or two ago. So for all of you who've got nothing to do on the weekend, print it out, or we can send you a copy. But it contains our views and some very interesting articles from across our business. So I'm going to talk together with three of our fund managers with the way we see the markets. I think the key message that we're sending out nowadays is you must become a global investment citizen. The South African buy and hold strategy, which is kind of broken if you look over the last 5 years. It doesn't mean there aren't opportunities in sectors from time to time in South Africa, but we're increasingly increasing offshore exposure. And we're going to talk quite a bit about global equities. And that consumes a lot of our time and attention. From a shorter term perspective, we're projecting about an 11% return from SA equities over the next 12 months. So not terribly exciting, measured by what was achievable over the last 10 or 15 years. And there are some elements of the market. It's important to break down the market. There's some elements of the market that we think can give some quite nice returns. From a global perspective, we think the global economy is recovering. Nolan covered the whole coronavirus issue. We think it's becoming more about not what the coronavirus does, but the fear over the coronavirus. And I think people are just becoming accustomed to the fact that it's part of our lives and are largely getting on with life. It'll probably take kind of midway through next year for the global economy to get back to normal levels. There'll be a lot of volatility. My son got caught in a super spreader event at Cape Town Varsity a few days ago, so he's got coronavirus. And certainly the fear of it is dramatically different. He's got no symptoms. 2 months ago, the whole family would have been in shock, but we're just kind of getting over with it and moving on. This is really the story of the markets in reaction to, and what's driven the markets in reaction to the coronavirus shock. And this is money supply in America. And this is really the stimulus, a graphical representation of the stimulus that happened. And you can see the fastest money supply growth on record. And that's what's brought the market back and brought the market back to levels where we think they're kind of reflecting the potential of shares. So I always like just to take a very simple graph of putting the markets in context. This is the MSCI World, so a world index. And you can see going back to January 2020, we had a massive dive, kind of a 35% drop. And then there's been a slow, steady increase back to kind of current levels. So if you'd gone to sleep in January and woken up now, you'd go, well, nothing's happened. But in the meantime, we've obviously been on a big roller coaster ride. The S&P is similar, but it's landed up a few percent in the positive equation. And I put two slides there, which are kind of bellwether non-tech type shares. So McDonald's, you can see a massive drop and is in fact higher than it was at the beginning of the year. So, you know, we as Neil indicated at the beginning, we started the year saying we were fairly cautious because valuations are quite high. And the valuations dived, but have got back to those levels. So while we're positive on global equities, we're talking 5% in dollars, which is below the long-term average. One has to gradually continue positioning oneself in global equities. But we think you have to work quite hard from a stock picking perspective in order to get, kind of double-digit returns. Something like Nike, the little graph on the right-hand side, that's now up 30% year to date. It's a company that's adapted well to the environment and is almost getting a bit of that tech flavor in terms of the way that they sell their product. So this is the most important slide, which we keep on showing and updating. So here's the S&P, which is up 5.6% year to date. But within that, the average share is kind of flat. So you've got healthcare, materials, all up 4 or 5%. Technology up 35%. And financials and energy down 20 to 50%. And that's really the global space that we've got to negotiate. We strongly believe over the next 10 years, the growth and the consistent compounding growth is going to come out of tech-related companies. But we've got to play off the valuation and make sure we're in the right shares at the right points in time. And Nick and Henry will go through more of that. We do see opportunities towards the bottom of the chart, and we're still able to buy selective shares at 10 or 20% off they were at the beginning of the year, and companies that we think can be, the same companies in 2021 that they were in 2019, but at a significant price discount. So in our global segregated portfolios and in our funds, like our equity fund in South Africa, we've got things like a JP Morgan, where we think trading at very attractive levels. The world market valuations, obviously with earnings going through the floor, the PE multiple is now looking like close to kind of record highs. But I think it's important to look at this table. So what I've circled there is the forward PE of the market, current 1 and 2 years out. And you can see on that same line, the 45% earnings growth, which is really the recovery growth. And then you can see this is Bloomberg consensus. Analysts forecasting a fairly decent year thereafter. And some of it on the basis that it'll, not all companies will recover their earnings in a 12-month period. So if this comes to pass, valuations then go back down to the kind of 16, 15 type level. On this chart, the average was just below 16. So the market is pricing in a pretty decent recovery. The way it's priced that in is to place a big premium on the technology sector. And you must remember that a lot of that is earnings driven. So a lot of the technology companies, their earnings prospects have been accelerated quite significantly. So they are much more valuable businesses than they were at the beginning of the year. We then get to the US election. For those of you, Peter Little, who is part of our strategy, helps run our managed fund, has done an excellent piece in our note that we sent out this morning and in our navigator on the US elections. And just looking at the different scenarios and how they can come about. I think the key message is if you get a blue sweep, and really it's all about that Senate column, we think Biden will probably land up being the president, although we're all quite nervous because we remember the shock that occurred last time, where the polls were kind of defied when reality came through. And the scenario of, if things stay as they are, it's more of the same. If you do get a blue sweep, for the president, the Senate, and the House, you've then got two kind of inflicting forces. One, tax rates are probably going to go up, but on the other side of it, government spending will increase, and we think the one will offset the other, and the market is certainly starting to price that in. So in other words, we're not particularly concerned, and we don't think the election and the result will have a massive impact on the market. A Biden result could be a positive. What we are concerned about, however, not from a long-term point of view, but from a short-term volatility point of view, you're going to get the election on the 3rd of November, but there might, with all the mail-in polls and the like, we could well see the election results taking quite some time to be confirmed. And if Trump loses, one can expect some I guess, unexpected moves from him. So you could see some volatility. That is priced in. What we're showing here is the cost of protection. So you can buy the VIX index futures at certain dates, and you can see how the price of the volatility index by date kind of peaks at the election time and then comes down. So the market's expecting volatility. We don't think that changes the long-term value of assets. So our approach is, to have some cash at hand moving into this. And if this produces some pricing opportunities, to take advantage of that. The last time there was a disputed election in 2000, the market went down by 8%. So, that's the kind of volatility one can expect. So within that global market, you're seeing the tech sector move sharply. Here you can see the potential still e-commerce penetration, while it's been growing dramatically, is still quite low. There's a lot more growth. People like Morgan Stanley saying that online sales will go from 25, 30% to 50% over the course of the next 5 to 10 years. So this is certainly where you want to be from an underlying growth perspective. Something that our tech team always points out is, we view online retail as simply a shop on a screen where you can go and click on a product. Whereas I think what one needs to understand is that the way that people behave is changing. So people are shopping in a different way. They're not going into a shop, they're going into Instagram. And this is an Instagram shop where you can have an experience and get sold the product, and it becomes a social commerce or immersive experience. And 63% of Americans use Instagram daily. And 60% of these are using new products and discovering them on the platform. And I think importantly, the long-term value of a digital customer is more than 4 times an average customer. So where we sit in the ever-changing world is social commerce, is in the traditional world, the Shopifys and the Amazons were selling the product, getting the logistics done and doing payment processing. We're now seeing Facebook enter the commerce world through what we call social commerce, where people are buying products on Facebook, and that has strong potential to increase ad spend and then take a take on the products. So that's the tech side of things. On the other side of things, as we explained, there's a lot of shares which are at lower prices than they were at the beginning of the year, where we think there is nice upside potential. So one of those that we've identified here, just to give an indication, is JP Morgan. And in the top right-hand side, I've put the share price graph, where you can see it's trading at values, kind of 30% below the beginning of the year. This table just shows the reserve buildup. So we think that'll peak. They obviously had to make big provisions for credit losses at the half year, and then increased from 25 to 34 billion. But this is not an all fall down situation like 2008, where the banks went into massive losses. JP Morgan will still be profitable this year, and you can buy a business with a 17% return on equity now at 1.6 times book. So we think there's space for these type of shares as well in the portfolio. This chart just shows the quality of the loan balances out there compared to 2008, where the big issue was the subprime category. Banks have been a lot more conservative over the last 10 years and in pretty good shape. So from an equity perspective, our global high street equity, which is our flagship segregated portfolio, we run a lot of those portfolios for financial advisors. That's delivering exactly what it says on the box. Since inception, 12% per annum in dollars against a market of 10.9, outperformed quite nicely over the last 12 months. And there it's a nice, fairly conservative balance with a growth focus across global equities. Nick Dennis is going to talk to you a little bit about the Anchor Global Equity Fund. I think Nick's having the absolute time of his life. He is somebody who's focusing on the kind of multi-bagger, big upside potential type shares in the world, and delivered a phenomenal 72% return over the course of the last 12 months. And Nick will tell you his thinking as we flow through. From an SA equity perspective, luckily Nolan's talked all about the SA economy and the different scenarios. I think in summary, we think resources look pretty attractive. Global infrastructure stimulus, both here and around the world, I think is going to pervade. And we've seen quite an interesting equation recently where the resource prices have moved upwards, but the share prices haven't followed suit. So we think there is another leg up in the resources space. For example, a company like Impala, if spot prices we put into its earnings now, you're talking about a 3 or 4 times PE multiple. Naspers, I think the market's completely exhausted with the whole discount argument. But we think they've made quite clear that they're taking steps to exercise that, but they need regulatory and other approvals. So I think people are almost not interested in that story, which probably means it is the point at which things turn a bit. To put it in context, Tencent has gone up 58% year to date. Naspers is only up 33%. And that's obviously that also doesn't, from a rand currency perspective, it's lagged significantly. There are some opportunities in the rand hedge space. They're not homogenous. One has to look at it company by company. So a projected 12-month return of 11.3%. 2 pictures, if you want the slide pack, we're very happy to send it to you. There's some detail here that I think is very important to understand. When we talk about the SA market, we've broken it down here into industries and profit drivers. And you can see the SA market is really a kind of financials, materials, and technology sector. So your 44% of the SA market is driven by the SA economy. Another 42%, importantly, it's not so much a global share portfolio as an emerging market share portfolio. So if you've got SA equity, you're effectively buying into emerging markets with an SA bias and a strong bent on commodities and technology. So one should supplement that with developed market equities as opposed to further emerging market equities. We've then taken a view, this is not a market return point of view, but a 5-year earnings growth. And ultimately, it's earnings growth over time that informs what happens to share prices. So we've taken those share categories, so financials, NASPAS, etc. We've looked at what we think the bull and the bear case is from a 5-year perspective in terms of what they can grow their earnings by. I could talk about this for half an hour, but in summary, what I've circled on the right-hand side there is the bull case is earnings growth of 10% per annum on a weighted basis over the next 5 years. And a bear case is flat. The base case is kind of somewhere in between that with 6% earnings growth. But obviously within that, you're going to have the commodity companies rising dramatically and then having a cyclical low. NASPAS is likely to give you pretty strong sustained earnings growth. And a lot of the SA Inc. type stuff, it's difficult to see with GDP after this year, probably running at 2 to 3% and then maybe even coming down from there, how they can sustain above average growth. So in summary, you will see some nice share price performances, and that's our job, is to identify and guide those along the way. But the buy and hold strategy from a South African market, which is 1% of the world, we don't think is the core philosophy right now. And one needs to increase that global exposure. In talking through NASPAS, I think it's important when you look at the share just to understand the gravity of what's happened in the technology space. And this is 1990, 2000, 2010, 2020. 2010, Tencent was the number 18 company in the world. Today, it's the 6th biggest company in the world by market capitalization, and in fact reached a record high this morning. So we're talking about one of the top 10 businesses in the world that you're getting exposure to. I've then just done the old discount slide. I think we're just going to leave it at that, sitting at a 56% discount to its fair value. So we think over the course of the next 12 months, that discount, that it's really kind of, you could justify a 20 to 30% discount. I think that's where a lot of NAV type plays, as people view them around the world, are taking place. But I think our recent discussions with management lead us to have some confidence in the fact that they can do some things to narrow it. And you're coming from such a low base. So A, we like Tencent, despite the fact that it's run very hard. We think its prospects are excellent. And 2, you're buying in at a very low discount level. So we see some nice prospects for that. This is just, we talked about the resource side. This is just in the third quarter, what resource prices did. So particularly in the platinum group metals, you see 20 to 75% price increases, iron ore up 23%. And the market's kind of having a breather on the resource share prices, which we think creates an opportunity. So to sum up, my part of the presentation, we think the traditional big league asset managers who are managing huge equity bases have to defend the status quo. We think that SA, you should be opportunistic, focus more on offshore. We've shown you that the long-term growth in the base case is fairly unexciting, but there are opportunities within it. From a 12-month perspective, we've explained why we think there should be a reasonable return from SA equities. And from a global equity perspective, some very exciting growth stories out there. But we've shown you that the high-quality companies are back to levels above the beginning of the year. But there are some opportunities, particularly in the financial sector, in good businesses with good prospects that you can buy kind of at a 20% discount. So that covers my segment of it. We're now going to spend 5 or 10 minutes with Nick, Henry, and talk through their segments of the market. So Nick runs our global equity fund, which is on the Sanlam platform offshore, and locally you can buy it through the global equity feeder fund. Nick, your funds had an absolute dream time, kind of 50, 60, 70% returns, depending on how you look at it. How do we view, when something's done so well, it creates a little bit of nervousness. Perhaps just give us your thinking as to the future from here.
Okay, cool. Thanks for the introduction, Pete. I'm gonna talk you through. I think if we take a step back, I think it feels like quite a strange environment for a lot of people. Obviously with COVID, and then with everything that's happened since, and where markets are sitting, and so yeah, certainly, like I don't think we're not in Kansas anymore, and I don't think we're going back to Kansas. So I think there's two, from my perspective, there's two major themes in the market that I'd like to talk about. The first one I think is my view is equities are quite expensive, particularly the good ones, but I think they're going to stay expensive, and they might become even more expensive than we've seen up until now. So some of the major factors at play are very low, ultra low interest rates, the rise of passive investments, so that's a totally value agnostic buyer. Asset scarcity, the amount of stocks, listed stocks has fallen over the past few decades. Like highly supportive policy action, and all of this leads to the acronym TINA, which stands for There Is No Alternative. So what this chart is comparing is the PE ratio of the S&P 500, and it compares it with effectively the PE ratio on bonds, on the 10-year US bond. And this is just the inverse of the bond yield. So if the US 10-year is trading at 70 basis points, that's a roughly 130 times PE. So what I think is that there's going to be an upward drag on PE multiples, but it's not going to be spread evenly across the board. The rising tide is not going to lift all boats. So I think for companies that are high quality companies with some growth, doesn't even need to be high growth, it needs to be some positive real growth. I think those companies are going to see their multiples expand, as has been the case through COVID. And then I think there's going to be a whole cohort of companies that are sort of low quality, no growth or declining earnings, and the companies that are really at risk of secular disruption. I think they're going to get cheaper and cheaper, and they're going to stay cheap. And so I think what you've already seen this year and over the past few years is a real bifurcation in the market between the winners and the losers. And I think that trend is set to continue over the foreseeable future. I just would not bank on mean reversion. So that's the first idea. The second big idea is this idea of what I like to call it the second Cambrian explosion. So the first Cambrian explosion happened roughly 500 million years ago, and you had this explosion of new life forms created over call it a 20 million year period. I think, and that's kind of an analogy for where I think we are today. I think we're in an explosive period of new ideas, creativity, innovation, new business formation, and really that's been led by technology and enabled by tech. So just to give you some examples of these are actually funds, stocks held within the fund, and you've got these companies that are acting as platforms, and they are the building blocks for other businesses, small businesses, medium-sized businesses, and entrepreneurs to build and create on top of these platforms, and also software developers. So what you've got now is you've got a world where, kind of like the Lego blocks, you're getting sort of enterprise quality, mega cap quality tools and products getting farmed out to individuals and small and medium businesses, and they can build on top of that. So it's just leading to a wave of like exciting new things. Now, if there's one word that really sums up what I'm looking for in the Anchor Global Equity Fund, it's multi-baggers. So it's companies that can grow 5x to 10x over the next 5 to 10 years. Now, what I'm trying to illustrate in this chart is that typically the asset managers tend to use just the left side of the brain, very logical, very spreadsheet driven. But I think to play in this realm and to discover these opportunities, which are often rather unorthodox, you need to use the right side of your brain. It takes imagination, it takes creativity, it takes some thinking outside of the box and thinking, where could things be? And I would also think it takes like quite an optimistic view of the world. I don't think this is a place where pessimists will naturally succeed. So this shows just how the Anchor Global Equity Fund, this is the offshore fund, is done, up 54% this year versus the MSCI All Country Index, which is up 1.4%. And this is as of September. And then if we look at you can also access the fund through the local, the Global Equity Feeder Fund, and that's up 75%. So in Rand terms, you've got the difference there. So 75% versus 21% for the market in Rands. So looking ahead, I still see just enormous opportunity in the kind of multi-bagger space, the innovative companies, these kind of platform companies that allow other companies, individuals, companies to build on top of and thrive. I think it's a really, really exciting time to be an investor and a stock picker. So things have done well, but I think we're in a very, very exciting time. So I remain bullish. And,
also, just to clarify, so yours is a global equity fund. What are you doing outside of the kind of tech space? What kind of companies are you supporting and buying?
So look, I mean, the vast majority, almost all of the companies are tech enabled in some way. So, I mean, just to highlight, this is not a tech fund, but it does. I think tech sort of touches is a key part of almost all of these businesses. So they're not all software, but there's e-commerce, there's software, there's payments, there's social, like a whole host of different businesses with their own idiosyncratic drivers.
Yeah, fantastic, Nick. Thank you very much. We'll now hand over to Henry Biddlecombe. Henry's been with us for 5-6 years, developed a strong appetite and analysis in the tech space. So we've got Nick's Global Equity Fund, which can invest right across the market. We have a local BCI, Anchor BCI Global Tech Fund, which is Rand denominated and accessible in SA. Henry is the co-fund manager of that, talks with a lot of passion, and we decided to give him a bit of time just to talk through, how he views the tech world. And Henry, obviously, with a big focus again on, this up over 50% this year. Where do you see the opportunities, and how do you approach that?
Thanks, Pete. Good morning, everyone. So there's no doubt that the proliferation and subsequent performance of technology companies across global equity markets has been one of the most prominent investment themes over the last decade. And a great way to illustrate that actually is to show you this graph, which shows you the relative performance of the NASDAQ, which of course is a tech-heavy index, relative to the S&P 500 over that period. And you can see that if you'd held the NASDAQ instead, you would have outperformed the S&P 500 by around 175%. Now, for any investor, that's life-changing money. But of course, the million-dollar question is, what will that relative performance look like over the next decade? And our view is that the trend you see on this chart will simply continue. And that's not a hunch. That's attributable to what we feel are clearly identifiable, very fundamental and very measurable driving forces in the tech space. And these are forces that we've spoken about with you before, so I'm not going to spend too much time on them today, but just to run through them quickly. It's the frankly astonishing research and development spend coming out of that space. It's the frankly superior economics that technology companies benefit from, and we call them network effects. And then it's the relentless pace of innovation coming out of that space as well, and that's something we'll explore a little bit later. If you guys are interested in a sort of more in-depth discussion around these driving forces, please go to our YouTube channel, where you'll see a 12-minute video that we've put together that explores these driving forces. It's called The Tech Imperative, and it's there for you to watch. And it's also an interesting video to perhaps send to your clients if they're interested in the tech space or our fund. So I thought what I'd do is I'd spend a little bit of time together today exploring what I feel is probably a widely held misconception among many of our clients at this stage. And that is, if you were to present the technology story as a clock, most people feel that we've only got around 15 minutes left. Whereas we feel that the truth is we're only about 15 minutes in. And to explain why, I thought what we could do is we could just chat about some of the more interesting themes that we're invested in, through our fund. And hopefully that'll give you an idea of why we feel there's still a long way to go here. Now, Pete kind of stole a little bit of my thunder with that e-commerce slide. And that for me is phenomenal. You know, just given the tremendous success of Amazon over the last decade, e-commerce penetration is still only sitting at 21%. So there's still a long growth runway there. But things are starting to change. And I think social commerce is an interesting one. And we're exposed to that through Facebook. Pete's already told the story, but actually it was really funny the other day. He came to work wearing a really strange mask, which kind of made him look like he works on the International Space Station. And you just kind of knew without asking that that was a kind of a spontaneous Instagram late night purchase. And when I asked him, he confirmed that. So the Instagram's definitely changing the way we shop. But some of the other themes I think we can chat through quickly. The first is platform economics. Now, platform economics is an interesting phenomenon. And that's where a technology company really starts to benefit from its scale. In other words, as it becomes bigger, so it starts to grow more quickly. And a great example is a little company that was not a little company, it's a little share in our fund, a company in China called Meituan Jianping. The best way to describe it would be it's the Amazon of services in China. So it's your sort of everyday convenience app that you use to complete many tasks. Their major segments right now include food delivery, ride hailing, and the booking of flights and accommodation. But the beautiful thing about a company like that is they have a base of 450 million users. So to grow, all they need to do is add a new product or a new service, and immediately you've got 450 million new customers. Now, with a total addressable market of around 1 billion users in China, we think that that company's prospects are fairly exciting. The second trend I want to discuss is distance learning. Now, I'm sure a number of you follow what's happening in the tertiary education market in the States, and we feel that in its present state, it's basically unsustainable. So students are incurring a huge amount of debt in the region of $100,000 to $200,000 to obtain a fairly generic 4-year bachelor's qualification, and they're then entering a fairly tight labor market, and they're struggling to pay that debt down. So in effect, they're underemployed. And then there's Chegg, and it's an interesting business. And what they've done is they've come out with a series of highly focused, shorter format courses, which are between 6 and 18 months in length, and they cost between $30,000 and $50,000 to complete. But what's most interesting about the model is that you only need to pay for that qualification once you obtain gainful employment. So it's almost a no-risk solution for a prospective student. The model's gaining traction. They've got around 3.5 million subscribers in the States today, and that's growing at around 30% per annum. So that's a trend we're excited about. The third is audio or podcasting, and that's a trend that's become almost synonymous with one company, and that's Spotify. Now, a lot of you would know Spotify as a music streaming service, but they're starting to evolve into something more complex. They've introduced video, so now you're actually watching shows instead of just listening to music or podcasts. And they've also added a layer of interaction to those shows. So now the hosts of those podcasts can interact with their audiences through polls, and I'm sure there'll be other features coming through soon. But the point is they're starting to look more and more like a modern version of a TV network. Now that blows open an entirely new addressable market, which is the global advertising market. It's around $560 billion annually, and TV advertising makes up around 1/3 of that. So if Spotify can end up just taking a very small share of that market, we think that this is a share that can go up multiple times from here. And the last one is a trend that I call the direct-to-consumer trend, and that describes the way that conventional businesses are making use of technology to build direct relationships with their customers, where in the past they needed intermediaries. And I think Disney at the moment is such a great example of that. So, of course, in the past they needed to show their movies through cinemas. Now they've launched Disney Plus. It's a streaming service that I'm sure most of you have heard about by now, but it's not simply a streaming service. If you really zoom out and think about it, what Disney have done is they've established a monthly recurring transactional relationship with, as of today, 60 million Disney Plus subscribers. And we think that in 2 to 3 years' time, that number will be closer to 150 million subscribers. And the opportunity they have to bundle in other Disney products and other Disney services into that subscription service is mind-boggling, right? Think about this. If you're a family with kids, would you pay $30, $40, or $50 a month for Disney Plus, for discounted tickets to access their theme parks, for early access to their blockbusters, perhaps for personalized birthday shout-out messages from your kids' favorite Disney characters? We think that a bundle like that would hold a massive amount of appeal to consumers. And as the business starts to look more like a subscription service, we think that the market will start to attribute more value to it. And so we think that this is a share that can re-rate upwards quite a bit from here. The other thing that I want to chat through is the way that value creation in the technology space takes place. And that is, it takes place in a very non-linear fashion. To illustrate that, what I've done is I've produced this graph showing the value of two companies going all the way back to 1996. And the first is Procter & Gamble. It's the blue line. Now, that's a very typical blue chip company that a lot of your clients would have owned through time. They pay around 70% of their profits out as a dividend, and they retain the other 30%. And they earn a return of around 10% on that reinvested capital. And you can see how the market value of that company has progressed over time, where the value creation at least takes place in a linear fashion. By contrast, look at the orange line. That represents the market value of Amazon. Now, Amazon is a typical technology company that reinvests every single cent of its free cash flow back into growth and back into new initiatives. But what I want you to take note of is how, as the company becomes bigger, so the rate of value creation starts to accelerate. And that's so typical of the tech space. And the most phenomenal statistic for me is that today, as one of the world's largest companies, with a market cap of, call it $1.7 trillion today, Amazon still created 50% of that value in just the last 2 years. And that's a phenomenon that we feel will continue through time. So that makes 2 points for me. One, it's important to maintain an allocation to the tech space for over a long period of time, because the value creation only comes through in later years. And the second point is you must stay the course for the same reason. Just to touch on the performance of the fund very briefly, it is a young fund. We only started it on June the 6th last year, but since then it's returned around 58% in rands. Around 18% of that is made up of rand weakness, so it's around a 40% dollar return. We're quite pleased with that. But what's more interesting to me is if you look at the makeup of that return. Now, what I've done is I've just tabulated the top 10 contributors to the fund's performance since inception. But I want you to have a look at some of the shares that have really contributed to the fund's performance. Companies like Spotify, Delivery Hero, Meituan, Junpeng. I mean, Delivery Hero is up 200%, Meituan's up 150%, Spotify up 100% so far. These are shares that you won't gain exposure to by holding a passively managed product. So in other words, a product that tracks a technology index, because these companies aren't significant constituents of those indices. And that's why we feel that an active strategy in this space is far more appropriate. And then lastly, I just want to end off by going through what we're trying to achieve as an investment team and with our fund. And that is, we aim to meaningfully outperform global equity markets by taking relatively concentrated positions in high conviction ideas. Typically, our portfolio turnover will be low, and that's because we aim to hold positions over the long term. And typically, we won't initiate a position where there's less than around 50% upside to fair value. Thanks, guys.
Great, thanks, Henry. I'm now going to move on to Liam. So Liam Hector's been managing the our SA Equity Fund for many, many years together with myself, and also runs our Anchor Accelerator Hedge Fund, which I think is getting it just right in terms of a risk-return balance. That was last year the best long-short hedge fund in the country. And in the tumultuous times of this year, up about 15% at the end of August. I think Liam sits in London, which adds a very nice dimension to the investment management of our equities. And he also there, with all the management teams coming through London, gets a lot of exposure to emerging markets, and particularly in the Accelerator Hedge Fund, takes quite a lot of exposure, positive and negative, to other emerging markets where there's some fantastic opportunities. Liam, the key thing that we all scratching our heads about in South Africa is exposure to SA, exposure to other emerging markets. How does one balance that Perhaps you could just talk through how you see the opportunities in other emerging markets, and how you see that relative to SA.
Sure, thanks, Pete. Hi, everybody. I think to try and summarize what's the sort of dynamic that's been at play for South Africa relative to the rest of EM, where it sort of fits in the world. At the risk of oversimplifying it into one slide, where obviously there are a lot of nuances at play, but I guess the easiest way to summarize it is in the space of a short space of time on one slide would be to just show the sort of different growth dynamics and the way that South Africa's participation has changed over the last, coming out of isolation and into sort of integrating into the rest of the world. What's become clear, right, is that the growth rates, as the growth rates tapered off in South Africa and the emerging world's growth rates accelerated, largely as a result of sort of emerging China and sort of the way that the sort of financial inclusion has changed across EM as they become a bigger part of the global pie. South Africa's kind of been left behind, and unfortunately, the result of which ends up with a far lower sort of participation rate in emerging markets. It becomes a less relevant place in a sort of investment universe where there's a additional complexity, especially for Western investors, to analyze, to make investment decisions, to DD companies. A lot of the investment resources and analytical resources then start shifting towards focusing on particularly the East. So I wouldn't say that South Africa, the chart on the left-hand side, is just purely a South African story. I think that there are quite a few emerging markets that probably have experienced quite a similar dynamic. But what you found is that unfortunately South Africa's relevance has waned, and even those stats are flattered by the fact that you've got a company like Naspers which struck it lucky in China and is propping up that number, probably close to a third of the close to just over 4% that it was at the end of last year. So I guess to demonstrate quite simply why this has happened, you can see on the right-hand side there the differential in growth between the two places, and I guess it goes down to the reason of why you want to invest in emerging markets in the first place. It's an asset class or geographic makeup that's higher risk, and you expect to achieve a higher return on your money, higher return on equity, and ultimately more growth out of those places, driven by sort of the more favorable demographic tailwinds. And what we've sort of found, especially over the last 5 years, where, on our numbers in South Africa, the sort of typically domestically focused industrial and consumer-facing businesses had their return on equities peak somewhere between 2012 and 2015 on most of the companies under our coverage list. What was happening was we were sort of getting forced into ideas that we perhaps wouldn't have executed in South Africa, and we sort of led us to start looking beyond our borders, trying to apply the same principles that we applied in South Africa, but still with a very focused geographical makeup. We didn't want to expand the sort of typical South African investment process just broadly across the world. We wanted to try and keep sort of focused on certain geographies that we could try and take advantage of quite interesting demographics that were playing out. So what we did was, particularly in the Accelerator Hedge Fund, was we expanded our investment opportunity sets to beyond South Africa, and by definition, the fact that it's a hedge fund means that you can take advantage of opportunities both long and short. And I guess we're finding that there was more growth beyond the borders, similar inefficiencies in the market, which is something that we've enjoyed about the South African market, and it's the reason why we still continue to be very active and sort of focused on South Africa. and ultimately just expanded our opportunity set and eliminated a lot of the mistakes that I think we would have made had we tried to sort of force ideas in South Africa. We were able to create a sort of core portfolio of stocks that really fitted what we were trying to achieve in terms of bottom-up drivers, and a lot of that sort of core portfolio, the low turnover, the kind of stuff that you want to anchor the portfolio in, was starting to be sort of constructed in geographies outside of South Africa, but yet within emerging markets. So I guess it begs the question of why keep any exposure to South Africa. I mean, a large part of the beginning part of this presentation was sort of highlighting the risks and the potential opportunities if a whole number of factors play out in a certain way. But for us, our strategy, particularly in the hedge fund, is less reliant on a market beta, or the markets necessarily just trending upwards. We found that over time, looking at our attribution, we're still able to generate positive alpha and positive absolute returns in South Africa. We still think that the market is one where there are great opportunities for sort of active stock selection, both long and short. In fact, at the moment, we're finding in South Africa one of the more challenging things is on the short side. So that's probably a bit of a signal to suggest that the South African equity market at least has plateaued for now, and with particular reference to the domestic equity market, the more cyclical South African businesses. But I guess we started in this industry at Anchor. We've had a passion for finding stocks, for finding opportunities, and I guess particularly in the local process, we were finding the team was getting quite frustrated with the lack of investment opportunities that got us excited, that got us sort of passionate or reminded us about why we joined this industry in the first place. And the refreshing thing is knowing that you can apply the same sort of principles to other emerging markets and generate or at least experience the same kind of outcomes that we experienced in sort of the lead up to the 2015 peaking of return on equity and investment opportunities within South Africa. I don't think that the argument of the South African local market being diverse enough or there's enough rand hedge exposure on there is justification enough for us wanting to necessarily bundle ourselves in South Africa. I don't think that holds true. I think that there's enough foreign currency exposure in South Africa as a percentage of the index, but quite concentrated into a very niche or very small opportunity set. So I definitely think where you have the ability to apply similar principles, investment principles to other markets, one should feel compelled to do so. But yeah, I guess the opportunity set for us has been interesting. It's been challenging, and it's one that's continuously evolving. And we're excited with the results so far. I guess it's on the chart that you're seeing on the screen there. It's been a grind, and ultimately that's what the strategy is there for. It's not there to take advantage of market beta. It's there to sort of try and concentrate your stock selection and extract alpha out of that.
Great, thanks, Liam. I think what the chart on the screen shows is proper returns, 15% plus per year with low volatility. So that's obviously what we're aiming to do. So I just want to sum things up. I think what you've heard from Nolan, Liam, Henry, Nick, myself, is where will the money be made? In domestic equities, I think we're making it quite clear that from a long-term perspective, the buy and hold strategy is troublesome. We think it's incrementally more attractive, but it's got risk. There are opportunities, and I think we've illustrated how we want to play that. From a domestic fixed income perspective, looked at from a global risk return perspective, yields of 8.75 to 10%. Buying bonds and just being patient, we think, is a winning strategy. From a global equities perspective, we've given you different perspectives on different parts of the market. Stock picking is obviously very important when the market has got fairly expensive, but we think there are still some opportunities. We are sitting with a bit of cash in the sidelines in our segregated portfolios. And then in global fixed income, to avoid duration, and obviously there's not much of a return to be held. Corporate bonds for 2% to 3% yields.